Hey there, Addy here with buildingsforsaletoronto.com, here with a very interesting opportunity that I think you should definitely be paying attention to. It's a 5-unit building in Cambridge. One of the units of the 5 has been broken up into 2 bachelors, so it currently has 6 apartments in it. 2 of the units are rented, so the 2 bachelors are rented, and so there are 4 units that are available. They're vacant and can be rented today. The backstory behind it is that the property was owned by a family and they didn't know they owned it, and there were people squatting in it. So they went in, cleaned the property out, and renovated the 4 vacant units. So they're ready to be rented. Each of the unit has its own furnace, has its own hot water tank, and it also has its own air conditioning, which is not very common. So the roof is new on the property. There's a couple of minor things that need to be fixed up around the property, such as painting. The exterior needs to be painted. It looks pretty rough. It's got a double car garage in the back as well. So it's a very interesting opportunity. I'd be all over it if I didn't have my cash tied up in other deals. But I think that one of you should definitely take a peek at it and see if this is something that you can work with. They're asking $888,000. Price per door is $148,000. The seller is willing to do a VTB. If you're putting 25% down, they will give you 75% at 5%. So you can get a 3-year loan, 75% loan to value, 5%, and the property would cash flow. Based on my projection, so let's take a look at the revenue, on the revenue side. So there's 2 units there, the bachelors that are currently rented, $955. Market would be around $1,000, so they're not that far off. Again, you could go higher on these numbers. This is my conservative estimates. If you take a look at the rental survey, the numbers are much higher. 1 bedroom, 1 washroom, $1,350, and the 2 bedroom, 1 washroom, I put it at $1,733. Again, don't forget these properties have air conditioning as well. There's no laundry at the property right now, so you can easily put one in and generate another $17 per unit per year. And there's no parking being charged, so you can actually charge $25 per parking on a monthly basis. So I haven't incorporated those into my underwriting. These are additional revenues that you can pick up. On the expenses side, they had provided with utilities. Now, the utilities also include a cost for the rentals for the hot water tank and the furnace. If you're renting it out to the tenant and it's plus utilities, the tenant pay for that. So this number would be much lower in your actual stabilized income, but I didn't change that number. So there's additional juice available here. Property taxes are $67.55. Insurance that they provide is $2,500. Now, these are the numbers that I incorporated into my underwriting. We put 5% for property management, so there's $820 per unit per year. We have general admin, $100. We put marketing at $50 per unit per year, or $300 per year. Repair and maintenance, $5,100. Contract services, like your lawn care and your snow removal, $3,600 for that. Utilities, $91.20. Again, using the number from here, but this number would be much lower. We have property taxes, $67.55, $3,300 for insurance because we bumped it up a little bit. And then you have capital reserve, which we put in there, $60 per appliance per unit. So we have 2 appliances per unit, so we put $120 per unit per year. So how does the income look? So $102,000, $447. Because there's vacancy right now, you have 4 units that are vacant. So I said, you know what, it's going to probably take us a month to fill those in. So we put our vacancy, instead of 2%, we put it at 4% here. So that's $98,349. Again, no laundry income added, no parking income added. Effective gross income comes out to $98,349. These are all of our expenses that we went through. So your net operating income is $63,766. So this means that if you buy this property at $888,000, this property will generate a cash flow or a cap rate of 7.17%. And don't forget, this is with a 4% vacancy. So the actual cap rate is much higher. I put in about $40,000 in additional expenses, and this is garage demolition or rehab, whatever you want to do, exterior painting, so fixing up some broken windows and doors, and then the basement entrance needs to be fixed up. So there's $37,000 that I put in there, and then I added another 10% contingency, so total capital budget of $40,700. So if you don't have to do this, if you don't want to, but the property is cash flow positive at $63,000, your mortgage is $46,767. So this would leave you at $10,000 in cash flow from year one, day one. That's the cash flow that is generating. If you didn't have a mortgage on it, it will leave you a unlevered cash flow of $30,766 in year one, year two, $59,000, and in year three, you're at $68,000. The idea here is that you buy this property with vendor financing and then you go and you refinance it with a CMHC mortgage. Let me take a step back and walk you through what that would look like. So in my summary page, we put this property mortgage at 36 months. Now, what we're saying is that after 36 months, we're going to go and exit into a CMHC mortgage. And we want to do an equity takeout. So if we are capitalizing this income at 5.5% and we need a debt coverage of 1.2 for CMHC, the calculations tell us that we can get a loan to value of 74%, or in other words, a mortgage amount of $939,067. Now, this number would be much higher if I can get a debt coverage ratio of 1.1 or an amortization of 40 years. That's the MLI Select program. So if you were to change this to 40 years, this tells me right away that I have a lot more juice available. I can go to 85%. I can go to 95%. No, not 95, 92%. There you go. I can get a mortgage of up to $1.167 million in 3 years if I play all my cards right and the MLI program is still in place. But because I don't know if the MLI program is still going to be in place, I'm going to play it safe. So I'm going to say I'm going to get a 1.2 debt coverage ratio, and I'm going to get a 30-year amortization. That's $939,000. Remember this number. Now let's go back to our annual cash flow. So I started my mortgage at $666,000. I'm paying the mortgage down. As you can see, my interest payments are $33,000, $32,000, $31,000. My principal payment is for $13,000, $14,000, $15,000. So I pay my original mortgage down to $623,000, and then I get a new mortgage at $939,000, and then it cost me 4% of the mortgage amount to get this mortgage. Now I was able to get $299,000 back. I had to put in $245,000 plus $16,000, which means $261,000, and I was able to get $299,000 back. Now I own the property free and clear. It's zero down for me from here. My returns from this point on are infinite because I have no money in the deal. So I can hold this property for as long as I want. This is a free annuity that I'm creating with 3 years of work. A really good deal. Definitely worthwhile for you to check out. If you're interested, reach out 877-439-2339, Addy at heyaddy.com, or text me at 647-370-9470. Take care. We'll talk to you soon.